Hello everyone, welcome to our Egyptian online seminar group. First, keep your phones off. Then, if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming dear Professor Charles Lee. Charles Lee is one of the top accounting thoughts in the leaders in the world. He is a professor of accounting at the University of Washington. He is also professor emeritus at the Stanford University. He has published in top-ranking journals in accounting and finance on topics that include behavioral finance, market microstructure, evaluations, financial analysis, quantitative investing, and security market regulation. Dr. Lee was managing director at Barclays Global Investors. Dr. Lee has received many research and teaching honors, including the notable contribution of Accounting Literature Prize. He has been the presidential scholar of the AAA. Professor Lee has been editor or associate editor of many academic journals, including the Accounting Review, the Journal of Finance, the Journal of Accounting and Economics, the Journal of Accounting Research, the Review of Accounting Studies, Management Science, and the Financial Analysts Journal. Now we will start our seminar with dear Professor Charles Lee.
Oh, thank you. Thank you, Mohammed. Good morning, everyone. I want to begin by thanking Mohammed for having the vision to create this kind of forum for bringing together researchers and scholars from around the world, and to thank him for inviting me to become a part of it. And I want to thank you all for being willing to attend live. I know it's 7 a.m. here at the West Coast of the United States. And I think if any of you are joining in Asia, it's getting very late for you over there as well. So I'm really appreciative of your attendance and engagement. I just want to maybe tell you a little bit about the paper that I'm sharing today, and also the people that I'm working with on this project. The title of my talk today is Production Complementarity and Information Transmission Across Industries. The version that I'm presenting is dated April 20th, 2023. It is on SSRN, so if you were interested, there is the paper, and then there is a great big internet appendix to show you all the nitty-gritties of things that we also did. The paper is under review. We just received the referee report, and we are revising and resubmitting. So we really do look forward to any feedback or suggestions, comments that you may have. My co-authors in this paper are Terence Shi. Terence is a PhD student at Harvard, and Stephen Sung, who is a faculty member in City University in Hong Kong, and Zhang Ran from Renmin University, a professor there at Renmin University. A little bit of complication in my affiliations. I'm currently at the Foster School of Business. I am retired from the Stanford Business School. They both, to some extent, support me, so I need to acknowledge both of my affiliations here. So, okay, so with all that aside, let me talk about this paper. When we think about how firms interact with each other in the economy, we can think in terms of vertical relationships, for example, companies who are customers and suppliers to each other. And we can think in terms of horizontal relationships that are companies who are competitors in the same industry. But as you know, in order to create value, generate goods and services, oftentimes the relationships are not just vertical and horizontal. And so the question we ask in this paper is, what about two companies that are neither vertically nor horizontally related? Are there other relationships in the production network that could actually bring them close in terms of economic affiliation? And the intuition that we used for this paper comes from the economic definition of what a complementarity good. So a complementarity good is a good that adds value to another good when they are consumed together. Maybe in America, we think in terms of milk and cookies. So we like milk and we like cookies, and we especially like milk and cookies. So one thing we know from economics is that the economic fortunes of complementary goods should wane and wax together. That is, for example, if the price of cookies increases such that people cannot consume as many cookies as they used to, then milk consumption will also decline. And similarly, if for some reason people decide to drink more milk, they may eat more cookies. How does that apply to companies? Well, we define companies or industries who produce distinct intermediate inputs to the same output industries as complementors. So industries and firms may not have a direct relationship with each other, but they may be connected in terms of who their ultimate consumers are. For example, battery manufacturers and the makers of semiconductor chips, like Taiwan Semiconductor, they may not be directly related to each other, but they both produce intermediate goods that are used in the making of smartphones. So technological breakthroughs in chips manufacturing calls for more powerful batteries, and longer lasting batteries also increase the demand for more powerful chips. So in this sense, these two companies and these battery manufacturers and chip makers are, in this sense, complementors. Okay? That is, they go well together like milk and cookies. Okay? So now this idea of production networks has been primarily emphasized by economists, and particularly macroeconomists. In fact, when we uploaded our paper, we became a top 10 download for macroeconomists, which probably says something about what macroeconomists get to read normally. But it also, I think, to them, the interest is that the evidence seems to support something that they have conjectured for a long time. So in macroeconomics, there are a number of influential papers that documented and postulated that in order to explain how economic shocks transmit and aggregate across economies, we need to consider these complementary relationships. So for example, Conley and Dupour in a Journal of Political Economy paper in 2003 documented a very strong co-movement in the outputs among complementary sectors. And in fact, they argue that it's very difficult to explain the kind of volatility in aggregate production that we see for an entire economy if we do not take into account how shocks in one industry aggregates because of these complementarities to other industries. Chad Jones, who's a colleague of Stanford in economics, have developed something called the theory of weak links. The idea is that just as a chain is only as strong as its weakest link, problems along a production chain can sharply reduce output under complementarity. That is, for example, and in fact, he argues this is one reason why we have sometimes very large differences in standards of living across wealthy and poor countries, because the poor countries often are the victim of weak links somewhere else. That even so, whereas more developed countries have less of that problem. And in particular, Atelier in 2017 estimates a multi-industry general equilibrium model where goods produced by different industries complement each other in the production of downstream industries. And he shows that the sectoral shocks actually can explain more than half of the variation in aggregate output growth, but only if you take into account these potential sort of trans-industry compounding effects. And so that's in macroeconomics. Almost all the evidence there is at a very high level of abstraction, basically at sector type levels. but the theory has been there. In microeconomics, there's also some evidence, mostly focused on specific events. In particular, I'll just point out the paper by Boheim et al. In 2019. They looked at a shock transfer that's associated with the 2011, March 2011 Tohoku earthquake and tsunami. And they noticed, because you can measure inputs and outputs between countries, they noticed that almost immediately after the shock, the inputs from Japan for intermediate inputs to come to Japanese affiliates in the US dropped sharply. But that's because those producing companies are no longer there. But what is more interesting is the non-Japanese complementary inputs, things that are associated also, that's also used for production in similar goods to the US, also dropped almost proportionally and almost immediately. So here's an example where the shock in Japan, which is very regional, has propagated very quickly to other non-Japanese companies, other regions in the world along the production complementarity network. Professor Hand, I see your hand up.
Sorry for the pun there. Just a quick question. Is the focus then of what you're doing on shocks or on the underlying mechanism without a shock? And really it's just the evidence that has been generated is along the shock dimension, because that's more isolating the causal mechanisms?
Well, so at this point, I'm just sort of summarizing the evidence in the economic literature, which is a very high level, mostly macro. And so in my next slide, I'll try to explain how our paper fits into that. Okay, so what do we do in this paper? So we study the capital market implications of these complementarity networks. Okay, so our focus is a little different from the economists because we're asking two questions. Number one, to what extent are the fundamentals of complementor firms correlated? Meaning we're trying to document as a first step the co-movement in the fundamentals of companies that are complementors, as defined by the economists. So the current evidence on these networks is based on sector level data or one-off events such as the earthquake. And we use highly granular, we're using firm level metrics, in fact, accounting metrics, to measure the co-movement of operating activities, financing activities, and investment activities of companies that are close in terms of their complementor distance. So we first develop a distance measure, a complementor distance measure, and then we look to document whether or not these firms actually move together, their fundamentals move together. Okay, so we use this to evaluate a long-standing proposition in economic theory. We use this also to essentially develop a new way to measure economic distance between any two firms, based on firms that are not in the same industry and have no vertical, no horizontal relationship, have no customer-supplier relationship, and no industry affiliation. Okay. And what we find is that this thing works extremely well in identifying economic affinity for firms that are not reported anywhere in the financial reports because they are not in the same industry and they don't have customer-supplier links to each other. Okay. So our first step is to document co-movement in the fundamentals of a group of firms that are not currently being identified by financial reporting as being peers or as being affiliates. So right? Okay, that's the first goal. The second goal is to look at how quickly new information propagates along these complementor networks. So to document lead-lag relationships. In the asset pricing literature, there is an increasing evidence that the news that are conveyed by the recent returns of economically linked peer firms are not incorporated instantly into the price of a focal firm. And this is called a momentum spillover effect. And I'll explain that in a little bit more as we go. But sometimes it's confusing to think about what is a focal firm. A focal firm is the firm that you are whose returns or whose fundamentals you're trying to forecast. That's the firm that if you're a hedge fund, you take the position in. Okay? And peer firm, what we're finding in this literature is that peer firm stock returns are predictors of focal firm returns. Okay, so let me elaborate on that a little bit. So the papers these are all finance journal papers. They report a lead lag pattern in returns of economically linked firms. So the earliest is probably some evidence on same industry. So in other words, if you take a bunch of companies and you sort them by their recent return in their industry. So for example, I pick General Motors and then say Microsoft and Abbott Labs, and you look at the returns of their industries and you rank them, and you buy the company whose industry did very well recently. So for example, maybe last month the tech industry did really well. Then I would buy Google this month, and then let's say medical devices have done very badly. Then I would short Abbott Labs. That strategy yields positive risk-adjusted returns. So it looks like a momentum strategy, but the triggering signal is the returns of the similar firms. Is that okay? Okay, so this is called momentum spillover, and probably the most famous paper in this stream is the Cohen and Frazzini 2008 paper, where they basically intuitively say, well, if you want to predict the returns of the suppliers, look at the customers. Find all the firms that are suppliers, find all the firms and supplier firm relationships, look at the recent returns of the customers, and the customer return, their customers have done well last month, you buy them. If the customers have done badly, you short them. Okay, and that turns out to be very predictive of stock returns. But the literature has moved very quickly in recent years. So for example, Cohen and Liu says, you don't really need customer and suppliers. You can actually look at, let's say you take a conglomerate. Conglomerate company consists of multiple lines of business. So I create a pseudo conglomerate. That is, I take pure play companies from each of those lines of business and weigh them according to the sales proportions of the conglomerate, and I create a pseudo conglomerate. It turns out the returns of that portfolio of weighted pure plays lead the returns of the conglomerates. And they argue that it's because the market is sluggish in adjusting in the pricing of more complicated firms like conglomerates. So the fundamental event has occurred, but it's manifested itself in the pure play companies, and then you can profit from it by trading on the conglomerates. Is all right? So far, so good. I may not see you all, so if you want to ask a question, you could just speak up. Okay, now this has continued to develop, this literature, so that we see that it's true also for U.S. multinationals. So in Huang, basically you look at a U.S. multinational, you look at where their overseas operations are, you form a portfolio of those overseas operation returns, or at least those country returns, and you predict the returns of the U.S. multinational. And then I was involved in a paper that was published 2019 in JFE, where we said this is actually true of technological expertise as well. So companies, what we are doing is we're measuring distance in terms of overlapping technology, and we use patent categories to measure the degree to which two companies have overlapping expertise. And these are companies that may be from completely different industries, but because their patents are overlapping in terms of the organizing or ranging or categories within the US Patent Office, their distance is close. And we find that this is actually, this pattern also holds there. In fact, probably So in every case, and then we've seen it also with companies from the same geographical location, and we've also seen it with companies with common analyst coverage, meaning that they are covered by an overlapping set of analysts. In fact, this last paper, Ali and Hirschleifer in 2020, argues, so in each case, what these papers have in common is that the recent returns of the economically linked peers are found to be positively predicting the returns of the focal firm. And in particular, Ali and Hirschleifer shows that after you control, so what Ali and Hirschleifer does is say, any firm that has shares at least one analyst, that has one analyst in common. So for example, my firm is covered by 3 analysts, but each of them covers other firms. So all of the other firms that are covered by my analysts are my peers. Okay, think of them as my peers. And then I form a portfolio of their returns. And what I find is that if I buy companies whose co-covered peers had the highest recent returns, like last month or last 3 months, and I short the companies whose co-covered peers had the worst returns, I create a very strong long-short return that has no exposure to no beta, no exposure to the market, no exposure to all the common factors in finance. In fact, this thing is so strong that once you include co-analyst coverage, Ali and Hirschleifer show that the other momentum effects all become insignificant. All of these become insignificant. So they conclude that momentum spillover is actually somehow a universal phenomenon that is succinctly summarized by analyst coverage. For reasons that they argue that's because analysts somehow are able to identify companies that have things in common better than we can using these other methods.
Charles, quick, sorry to meet again. So, sort of from the p-hacking point of view, do any of these papers do the counterfactual, which is, okay, take firms that you can measure are in no way related to each other, and this literature has become more and more in that sense. Everything is controlled for every which way. There are also new ideas about how to get rid of common shocks, how to get rid of reflection problems. All of that's there, but it's extremely strong. These T-stats are like massively big. So now, so why do we study this link in particular, since it seems like all these linkages have a lead-lag relationship? Well, one is that this is a solidly grounded economic theory. It's long postulated and highly intuitive, and yet there is no capital market evidence on its existence. And the other thing is, actually, the complementary relationships are not well disclosed. You're not going, we form our complementors from a group of companies that are not in the same industry. We explicitly exclude companies from the same industry. And we explicitly exclude companies who have customer-supplier relationships. So no vertical, no horizontal relationship. So these relationships are not visible from financial reports and far less likely to attract investor attention. And the other thing is, they typically do not have common analyst coverage. Why? Because they're from different industries. And so they're unlikely, if there is a lead-lag relationship, it's unlikely to be subsumed by the Ali and Hirschleifer variable. Now, they claim that momentum spillover is for whatever reason, an analyst variable. But what if the firms are economically linked and yet have no analyst co-coverage? So we want to understand that as well. So for all these reasons, we think the speed of information transmission along the complementarity networks deserves more attention. Is all right? Okay, so let me summarize our main findings, and then let me explain a little bit about how we go about doing it. And then I will pause again to see if you have any questions before I dive a little deeper. Is all right? Okay, so what do we find? The first thing we document is a very strong co-movement in fundamentals. So in fact,
we find that complementors, as we define them, and I'll explain more how we define them, but basically these are companies whose inputs eventually end up in the same set of companies, whose outputs eventually end up as inputs to the same similar set of companies. These complementors have very strong co-movement fundamentals. We see it in operating results, ROEs, sales growth, and financing results, like investments, capital expenditures, R&D activities, financing activities. We see it in issuance of equity, and we see it in even total leverage changes. We also see it in their earnings forecast revisions. So those operating, financing, investing activities are measured at the annual level, and we see this. This is even after we control for their own industry peers. And we also see co-movement in their earnings quarterly analyst EPS revisions. So their earning forecasts are going up and down together at the quarterly level, and their stock returns are contemporaneously going up and down together in the same month. So it's a monthly level. So what we've identified is a group of companies that in many ways are similar to each other, but have no vertical and no horizontal relationship. We also see a strong return predictability. These what we call complementor momentum. So that if you go long the companies whose complementors have done well in the last recent months, and you short the companies whose complementors have done poorly in recent months, you get an equal weighted return of 137 basis points per month with no reversals. Like, we don't observe them reversing, so they don't look like investor sentiment or fundamental or sort of overreaction. And when we dig deeper, we don't see that it looks like risk. In fact, we use 1, 2, 3, 4, 5, 6 factor Fama French type factors. In fact, they look more like limited attention because they are stronger when there is low analyst coverage, low media coverage. They are stronger for companies that with higher arbitrage costs. They predict the direction of future earnings surprises and so forth. So they look like mispricing. And finally, what we find is that the shock transmission is not only just from the peer firms to the focal firm. If we took a focal firm event that's actually patent approvals, when a focal firm approves a patent, we find that the abnormal returns on the date of the announcement of the approval patent is actually correlated with these complementor returns, controlling for their industry, controlling for market, and so forth. So it looks like that the shock transmits also from focal firms to peer firms. And in fact, there is also a lead lag in that information, which is news about a innovation rather than news about production. Okay, so those are the main findings. I will talk about the implications of what I take away from it towards the end of the talk, but these are the main empirical findings that we document. So what I'm going to do now is explain the data at the variable construction and the intuition behind this distance measure. Any questions up to this point about motivation? Okay. So other than the standard data sets that we use, CRISP and CompuStat and so forth, there are two main sort of less usual types of data. One we use is a table that benchmarks input-output between industries. This is provided by BEA, the Bureau of Economic Analysis, once every 5 years. And there's just a grid, a matrix that shows how much of each industry's flows of goods and services go into the other industry. This is a matrix that's widely used in the IO literature for identifying industry supply chains. And we use 9 different surveys. It's once every 5 years. And the reason we stopped in 2007 is because they no longer have the granularity in 2007, after 2007, that allows us to see 400 or so industry categories. But so what this matrix gives us is a sense of where the goods and services from one industry flows to the other. We make sure that the data is publicly available, of course, before we form portfolios or do any of this analysis. And then we combine that with the CompuStat's historical industry segment data. So starting in 1976, all the companies are required to report financial information by industry sectors, material industry sectors. And so what you can do is use that to come up with firm level sort of output, firm level output industry information, and then use the first one to convert that into the sort of downstream industries that they are providing. We call it an output flow measure. Okay. So here's the way we go about it. There are 405 different industries at the detail level in the IO table. And so we can express the proportion of an industry's output supplied to each industry, or a firm's output supplied industry as of time t, as a vector. So this is OI is industry A's average share of output supplied to industry K at time t. So what we can, just for every firm, we can see which industries they are actually supplying. And then we combine this with CompuStats. For every industry, we can see what other industries are supplying. And then at the firm level, we take the historical industry sector data for a given firm I, and then we essentially weigh it by sales and compute for each of them an output flow vector. And that gives you a measure of the proportion of their sales that flows to each industry. So for any two firms, any pair of firms, we can now compute something called what we call a compal measure, which is a measure of the complementary distance between any two firms. Now, this thing is called a uncensored correlation. It's really measuring the overlap in their output flow vector. Okay, we used a similar measure to measure technology distance across patent categories. It's pretty intuitive. Maybe just before this talk, I tried to develop a little example for you. So think of firms. So CompLij is the complementary distance between firms I and J at time t. And it's computed like this. Let's consider three companies that each have output to three industries. So the output flow of company A is no output to industry 1, 100% output to industry 2, and no output to industry 3. So company A completely supplies industry B, second industry. Okay, and a firm B supplies 50% to industry 1, 25% and 25% to the other two industries. And then company C supplies 100% to the first industry. Okay, if these are the numbers, when you compute the comp distance between company A and B, you can work out the algebra, and the comp distance between A and B, you notice also intuitively that they overlap in the middle industry. So there should be some positive comp score. And indeed, the comp score is 0.41. So this comp score is always between 0 and 1. It's a distance measure, and it's symmetric. So comp AB is the same as comp BA because it's a distance measure. Now, if you look at the distance between A and C, you can see that their outputs really have no overlap. They don't have any industry where they have any overlap. And when you compute the math, work out the math, in fact, the distance is 0. Now, if you look at company B and C, you can see that they overlap in the first industry, and in fact, 50% here and 1%. You would intuitively think that they are correlated. And in fact, when you work it out, their distance is 0.82, which means they're closer together, and in fact, more so than A and B. AB is correlated, but they are complementarians, but they are less close together. Any questions? Okay, so notice that. Yes. Hi, Bright.
Good to see you. So how would this measure look like for companies that are in the same industry but are not complementors, like the peers?
Yeah, we basically. Well, you can do this for any of these companies. So, but when we actually consider complementors, we remove all companies that are from the same industry with the focal firm, just to make clear identification separations.
Yes. Yeah, so this can exclusively identify the complementors, this measure.
Well, yeah, you can measure this distance between any two firms. And if a company has 100% of their output in one business sector, then it's really an industry level measure. Does that make sense? So for companies that are in the same industry and they're all pure plays in that, then they would have the same score. But we want to look at information transmission across industry. So we take out any peer that is from the same industry, and we take out any peer that has any customer and supplier relationship. Because that, you know, if they move together, it's people will say, well, that's obvious. So we want to try to find the less obvious off-diagonal variables and relationships.
Got it. Thank you.
You're very welcome. Are you in Hong Kong? Where are you?
Chicago.
Oh, okay. There you go. I feel less sorry for you. Okay. Okay. All right. So complementary distance. Okay. So this is the example I illustrated. One thing I forgot to mention. So similar to the distance measure, what's called cosine similarity. It was actually original development in 1986. On a paper by Jaffe, and then used by Bloom et al. To measure technology to overlap distances. It was also used by Hoberg and Phillips. Hoberg and Phillips was using this type of a measure using textual analysis. So they use textual analysis and compute a similarity score based on textual analysis, and that's also the same kind of metric. Okay, and we used it also in the technology overlap paper. It's always between 0 and 1. It's always symmetric in firm rank ordering. It's all right. Okay. Now, we impose further restrictions on complementors. Number one, we exclude any peer firms with the same 4-digit SIC code. We also, in our Internet appendix, exclude FAMA French measures, 1, 2-digit, 3-digit. So a whole bunch of different variations. And so the idea is to remove competitors and to focus on inter-industry information transfers. And we you know, because you can compute this measure for any pair of firms, we only focus on the top 2%. So this is a very computationally intensive calculation because you're measuring distances between any two firms. But we for each firm, we only keep the complementors in the top 2% in terms of distance. So the closest. This is actually very similar to what Hoberg and Phillips did in their paper on you know, similarity based on textual analysis. And then we remove focal firms with less than 5 competitor peers. So this is based on network theory that when a company does not have sufficient number of nodes, that they are sparsely connected, that it doesn't you know, the network theory doesn't really apply. So and then we do robustness checks. We drop firms that are similarly covered by common analysts. We did a ton of robustness checks. Any firm that has direct customer supplier relationship with focal firm and a variety of different ways sort of to see that whether it's robust. Okay, so now we have a distance measure. We have, for every focal firm, we compute the average monthly return of its complementors. Okay, and we, in this version of the paper, we weigh them by the distance between them. So the complementor returns for firm I in month T is defined as basically the returns of each complementor firm. That's the return right here of summed across all J's and multiplied by their distance and divided by the sum of their distance. The scaling actually isn't that important. If you use equal weighted, you get almost the same results. But historically, people have used these distance measures as weights. And so that's what we do here. In this construction, the comp distance serves as a weighting function when calculating the portfolio returns of the complementor firm. So firms that are closer to the focal firm in the network are given higher weights. Is all right? Okay, so now for every firm, we have comp returns, and that's going to be our trigger for our return test. Okay, so just a little bit of detail. We leave a 6-month gap between fiscal year and then stock return, make sure we have all the accounting data. We do we exclude financial firms because it's hard to figure out what complementors they really, how they interact with other non-financial firms. We drop stock prices at below $1 just to remove the micro cap stocks, but we also, in the robustness test in the Internet Appendix, we also exclude stocks below $5, not much difference. We only examine the top 500 firms in the market cap. Only S&P 500, we still see this effect. Okay, so it's not a small firm effect. And our sample goes from 78 to 2018 because we have to hold multiple years of period returns. Okay, so not much to show you here. These are the descriptive statistics. The number of focal firms per year, mean is 2,000, but median is 2,000-ish. So these are the firms that we actually are studying per year, on average about 2,000. The average number of complementors per firm is 127, and the median is 86. So the median firm has 86 complementor firms, and the mean comp distance measure, the positive measure, the mean distance measure is 0.11, meaning that the average distance between a complementor and the focal firm is 0.11. So there is some essentially overlap in their outputs, in their destination destination companies. Okay, so first, co-movement. So what we're documenting here is co-movement in operating performance and financing activities. And so we measure ROAs. These are annual ROAs, and the dependent variable is actually the ROA of the focal firm, the annual ROA, and then we regress it on the industry peer average. So the industry, the return, the ROA of the industry peers, and we regress it on production complementor ROAs. We include firm fixed effect, year fixed effect, and what we see is that there's a positive co-movement, quite strong. Of course, not as strong as their own peers, but quite strong incrementally in terms of the co-movement between between complementors and the focal firm. We see a co-movement also in their sales growth. So their sales, the level of sales growth or the change in sales growth is also positively correlated. We see it also in their financing activities, in their leverage, and in terms of their total amount of external financing. So these firms, remember, are not from the same industry, but they are helping to explain essentially the focal firm changes in financing leverage, sales growth, and ROA. So we see it also in investing activities. So CapEx is also correlated. Level changes in R&D, even the changes in the citation weighted patent. So citation weighting is simply saying how important is a patent based on subsequent number of citations. And you see a positive relationship, meaning that they are essentially investing at the same time. So really, these firms are remarkably, have a very remarkably close affinity with each other on many dimensions, even though they are not from the same industry. We see this also in stock returns. So we are regressing the contemporaneous return of the focal firm on comp returns, and we see a strong positive relationship in monthly returns. When we add a bunch of controls, we still see a T-stat of 22 on the comp returns. These are contemporaneous. Okay. And then when we add the industry, that only shrinks it a little bit. In fact, just to make sure that we fully removed it, the dependent variable in column 4 is the return of the focal firm minus the return of the industry of the focal firm. So this is industry adjusted variation. In other words, the deviation from the firm industry's mean is strongly correlated with the comp returns. So really what we see is that they are moving together. Their stock returns are moving together. We see that the quarterly earnings forecast revisions are also moving together. We control for industry peer movements in forecasts, which is not surprisingly correlated, but we also see that incrementally the changes in earnings estimates of these non-industry peers are also relevant in explaining the contemporaneous changes in the earnings of the focal firms. Okay, so it looks like they are quite related to in terms of fundamentals. The referee is at a finance journal really actually enjoyed seeing, he or she really enjoyed seeing this co-movement, so it wants us to expand it and show how it works and so forth. But so number one, there's a very strong co-movement. Number two, we wanted to test this lead lag or apply this distance measure to the momentum spillover phenomena. And so what we do here is we sort focal firms based on their complementary returns in last month. So, and then we form monthly calendar time portfolios. We rebalance every month. And then these table values are the intercepts from a regression of monthly excess returns on factor returns. So these are in column 1, we just have the raw excess return for companies with the lowest complementary momentum to the companies with the highest. And you can kind of see the companies whose complementors did really well last month are going to earn 1.4% returns per month in the next month, whereas companies whose complementors have done poorly last month are going to earn basically no premium relative to the risk-free rate. So these are risk adjusted by the risk-free rate or 10-year bond yield. So the long-short spread is 1.37% per month, and at evaluated basis, it's 75 basis points, even when you evaluate them. Portfolios. We do this for the 3-factor, the 4-factor, the 6-factor, and really not a lot changes. In fact, with the 6-factor alpha, you get a stronger value-weighted result. We do this with comp distance weights. We do this equal weights, very little change. So you might be curious whether we are, what kind of risk we are taking. So here is the factor loading, or think of this as factor betas. on the 6-factor model. That's the Fama-French 5-factor plus the momentum factor. And you can kind of, so for our short portfolio, our long portfolio, and our hedge portfolio, you can see that the hedge portfolio, these are the factor loading. So these are the sensitivities or coefficients on the market factor, the size factor, and the value factor. And you can see that the t-stats, which are in parameters, are all insignificant. So they really have no significant loading, no significant bet on the market. So uncorrelated with the market, uncorrelated with size, and uncorrelated with price to book. Now, it is correlated with momentum. So this strategy does better when momentum strategies in general are doing better. I think that's not too surprising because this is kind of a variation on the momentum, but not on the firm's own momentum, but on peer momentum.
Sorry, quick question. Can you go back to the previous slide?
Sure.
I'm curious what your thoughts are about why you're seeing such negative numbers on the low complementor portfolio. So those are ones where I thought you would imagine, I think, if I'm understanding what you've been saying, where you wouldn't expect to see anything because they're not related to each other. Or am I misunderstanding something?
No, I think that's a really good point. We didn't know what to say, like there are many, there's only, similarity we understand, but what does it mean to be different? It seems to me when they're different, that is far away from each other, there are many ways to be different. So I wasn't sure what we would have expected here. And when the negatives are here, the only way we can think about this is the economy is like a teeter-totter, and companies that are supplying a certain set of firms, when they're doing well, they tend to be, all moving up. But the firms that are exactly the opposite and not supplying at all any of these end up in a relative basis do worse. But it's hard to explain why they're reliably negative once you correct for the firm level factors. I actually don't have a good answer for that.
Okay, thank you.
Because I think something is going on there. I think that there is something systemic about firms that are very far away in this measure, meaning that if they are very different from the firms that are supplying on your focus, they seem to be negatively correlated with your future returns.
And so one small follow-up question. So of course you could flip the paper entirely, right? And in other words, your motivation has been on the complementors, right? You could rewrite this paper as the reverse.
Meaning that I use focal firm returns as the trigger?
No, just the fact that, somebody looking at the top of the chart here would say there's just as much of a, quote, big result at the top, as you've just mentioned, as at the bottom. And at one level, I think it would be wonderful in your discussion section of the paper to have sort of an equal share of, hey, we can explain what's going on with the high portfolio, but we have no idea what's going on in the low portfolio. But it's almost as interesting because it's almost as sort of puzzling, right, as on the reverse side of the coin as the expected result is on the side that you put forward.
Yeah, so this is I think this is actually quite a very good point. So the way the referee sees the contribution, and I think we're beginning to come around to that same view, is that we have a distance measure, and that the money we make in this alpha strategy is just an application, and that the more broadly interesting thing from a scientific perspective is just the distance. And the more we can tell people about this distance measure, the better. And so to your point, when the distance is far away, what are we learning? Okay, and now that applies not only to this table, but to all the earlier stuff too. Because this table, so the one thing about this paper, the first set of results do not speak to market efficiency much. It's just saying they experience common shocks. But the second part requires some relaxation of a cost-free efficient market, so like if there's any, the second part basically shows that yes, they are shocked together, and if markets don't fully get it, here's where you get the biggest lead lag. Okay, so literally we're number one documenting that shocks propagate. Number two, we're documenting the factors that affect the speed of propagation. So if markets are fully efficient, we may get nothing here. See, so because these are predictive returns, these are next month's returns, but it would be interesting to see, I think, this result contemporaneously, and then talk about it from that point of view. So your point is very well taken. So it's okay. Okay, so this was just to show that in terms of, I think, it's correlated momentum, not correlated with the first three factors. It's correlated in a weird kind of not clear way with the other two new accounting-based factors that Fama French added, robust minus weak, and conservative minus aggressive. Basically, that's RMW is basically just ROE, and CMA is basically just delta asset growth. Okay, so change in asset divided by asset. So these are all pure
excuse me,
there's no price
Professor
in their
Lee.
construction. Yeah.
So sorry. Yeah, aloha. So you mentioned that the measure is very computationally intensive. Can you hear me?
Yes, I can hear you.
Okay. Because I saw a comment on the chat from Mohammed about I opened my mic. Yeah. So you mentioned that the measure is very computationally intensive. Is it possible to make a measure available for others to use in their research?
Yeah, we plan to do that. Yeah, we would be happy to do that. It's actually also suggested by our referee that we want to make it as available as possible.
Yeah, that's great. My second question is, do you see some kind of like a hedge fund investment company using your strategy, or
I'm aware of two who are using it. So
okay.
One of them I know very well because I co-founded it. So
okay, all right, that's great. That's great.
Yeah, and the other one has a very successful track record, and probably don't want to. I probably shouldn't even mention their identity.
So you're getting very nice consulting revenue.
No, actually, I do it for free. I'm now a freelancing academic dispensing potentially flawed data information.
Yeah.
No, I'm just interested at this point in documenting what is happening and possibly understanding why it's happening. So,
thank you,
Professor Lee.
Yes.
I just have a question kind of about the measure, just to better understand it. To what extent is the measure influenced by international complementary firms? Where I know that your measure is based on the Bureau of Economic Analysis data, which I believe is like within the US, but then I guess some industries would have particularly high exposure to like international
yeah, I think that's
related...
I think that's a really good question. I think that in terms of the theory, it generalizes. In other words, if you can add, in addition to all these industries, some factor about geographical area, it would probably enhance the measure. But what we're relying on is an input-output table that really does not make that distinction. And also, in terms of our universe of companies, these are all American companies. Mm-hmm. So both the complementors and the focal firms are in the Chris CompuStat universe. So,
but they could be multi. I guess they could have some operations.
So the applications that I'm aware of among hedge funds is international.
I see.
Meaning you can do the same thing with a broader sample, but that's not what we've done here.
Got it. Okay, thank you.
Yeah, in terms of an alpha signal, it is attractive because number one, it is not obvious. Like the most obvious momentum signal is the firm's own returns. Now we're finding that as things become less obvious, the speed of adjustment takes longer. So here's one that's pretty not obvious, and it seems to take longer. Okay, so here's Yes. Hi, Bai.
I'm thinking back about the definition of complementary. It says it's a complementary good is a good that adds value to another when they're consumed together. So does that necessarily imply the complementors are similar in that distance measure?
Well, I don't know if we could have predicted that they would be similar on so many dimensions, but we find that they are. Okay, we could probably look at this and say, oh, well, I can tell you a story why they should invest together, and they should raise funds together. But we really didn't have such a great story. This is the first time that I've seen this thing documented. We simply said, wow, it's not only earnings, it's not only returns, which is what academics tend to focus on. It's actually the entire economic apparatus of the firm is similar, even though they're not in the same industry.
Interesting. Yeah,
I think though, I can certainly see how this might happen because exactly the same kind of reason why economists had hypothesized this, because they are essentially, it's that weakest link argument. If anything bad happens along the chain, they all get affected. Anything positive happen, like for example, in a technological breakthrough, they all are going to benefit. And they probably will all raise money at the same time. They all will, yeah. And so in some ways, their similarity extends far beyond earnings and returns.
Yeah, I think it's not very obvious to identify the complementors. When I just think about like listening to music while exercising at the same time, it seems to complement each other. But do those firms that supply music versus supplying exercising equipment, are their output, like the industry output, do they overlap?
I think I was just using milk and cookie as a just like trying to explain the intuition, but actually I think there are complementors with very close and ones that are very far away. And I don't know whether I certainly never listen to music when I run, right? I actually am, doing other things, things that don't use too many brain cells, but not quite like music. So I think that there are different distances, right? But what we're measuring are companies whose outputs become inputs to the same group of companies. So I think that is, and also we are measuring it by distance. So we're only focusing on the companies in the top 2% of the distance, the closest 2% to every company. So, you can always think of examples where there might be some loose linkage. And certainly this isn't by no means perfect, but we're just simply pointing out that the connections between firms are much more complicated than vertical and horizontal. And you can document it in a fairly strong way. Does that make sense?
Yeah, thank you.
Okay. And occasionally we might want to make some money from that, but okay, so this is the hedge fund return. So most of the returns are earned in the first month. So you can see the pop here, the 1.37, and then you get a drift, but then it goes away. But then it never really reverses. So it doesn't look like overreaction. It just looks like sluggish adjustment to recent news. So one question people may have is, did you rediscover Alley and Hirschleifer? Because they claim that it's all spillover effects are one unified phenomenon explained by co-coverage. So we rerun our results. We take out any complementor that has any firm, any common analyst with the focal firm. And you can see that the effects marginally decline. If you use the 6-factor alpha, it declines by 20%, meaning that the analysts probably have some ability to identify these types of linkages. But once you take out the common analysts, the linkage is still there. And in fact, you're still making over 1% a month, even with no analysts. And then, so we then got interested in what is the role of the common analyst? Well, in Alley and Hirschleifer, common analysts help you identify economic linkages. But you know, as accountants, we always think of analysts as information intermediaries. You would think that the analysts should help the market figure out whether something is relevant has happened in the set of stocks that they monitor. So why is it that they are so incredibly inattentive to stuff that they should have incorporated? So what we do is we separate all the complementor peers into 2 groups, depending on whether they have a common analyst with the focal firm. And then we construct a complementor momentum signal for each group. And then we report the 6-factor alphas earned by each strategy. So here, what you see is the correlation between the 6-factor alpha of the focal firm and the complementor returns. So when there is no common analysts between them, around 30%, you could kind of see 29.7%, that is, of the total alpha is realized in the future. Meaning that if you sum up the alpha for these next 3 months, it will be about 30% of the total alpha associated with the month T shock, if you will. But if they have at least one common analyst, only 12.5% of it is a drift. The other 87% actually gets incorporated in the very first month. So in fact, what we see is analysts are doing 2 things. 1, help you identify economic linkage, but number 2, actually helping to make obvious that these returns are relevant. And they get incorporated faster when there are analysts. Does that make sense? Okay, so in general, having at least one common analyst with the complementor seems to speed up the focal firm price discovery process. Okay, so there's a spanning test that the finance people like to do. So the idea is that you take the portfolio alpha from monthly time series regressions of these returns on a set of common risk factor returns. Okay, so you're running these time series regressions, and what we find, basically, is that if you add the common analyst as another factor, so now you have a 7-factor model with common analysts as another factor, you still do not fully explain our returns. So here's the 7-factor result. So really what we're saying is Alley and Hirschleifer's conclusion is a bit of an overreach. It's not common analysts that characterize all momentum spillover. There's a momentum spillover that's not characterized by common analysts. Okay, now could it be that we've rediscovered one of the other earlier economic link? So we look at customer and supplier link. We control for that. We control for the Cohen and Liu's lagged pseudo conglomerate. We control for tech returns, and we control for Alley and Hirschleifer returns. And what you see is that, yeah, we can replicate their results. They all load in terms of explaining focal firm next month's returns. But more importantly, they don't get rid of the comp return. Okay, so underlying mechanism. What are the cross-sectional drivers of our main prediction result? Well, we find that this in the cross-section, the result is more intense for companies that are closer to each other. in terms of their distance. And that's, we call it complementarity intensity. If they're closer in this distance, there is a stronger relationship, contemporaneous and in predicting returns. Network centrality. So focal firms with more network connections have a higher degree of network centrality. And in network theory, they should actually incorporate more slowly because they're getting information from across all these different companies. It's harder to predict, and that's exactly what we find. Investor attention, focal firms that receive less attention have slower price adjustments. You can measure attention in terms of firm size, analyst coverage, media coverage, and institutional ownership. And arbitrage costs. Focal firms that are more costly to arbitrage will exhibit slower price adjustment. We use idiosyncratic return volatility to approximate that. And we find the same, all these things hold. So it looks a lot like the underlying mechanism has to do with a slow adjustment to recent news.
Quick question, Charles. Sorry.
Yeah.
Could you go back to, so I buy B, C, and D. I think what I find puzzling about A is I would imagine, all else held equal, that if you're a firm closer to the focal firm, it would be, quote, more obvious to everybody in the world that there was, so that, that you'd be related to each other, which is not the same thing. I wouldn't get the same thing.
No, actually what you will find is there are really two effects. One is closer, meaning that it's being measured with less noise. The common shock is being measured with less noise if you get good focus on it. The other is informational friction, which is how easy is it for investors to recognize, how transparent is it, and how easy it is for you to trade on it. Those two things work in opposite directions.
So you're saying that A is the net of two things?
No. A is measuring the true economic distance. That's the way we think of it.
Right.
But true economic distance does not necessarily become more transparent.
No, but all else held equal, I would imagine it would be, right?
Yeah, but remember, this is supposed, if it is really measuring true distance, this is the piece that the market does not fully get.
Well, I can see that, again, not to belabor the point with regard to B, C, and D. I can see those as sort of informational frictions. I just, again, to me, A seems to go the other direction. It would be...
Oh, I see. You don't want to call that informational friction. But think of it as investor inattention, and A is measuring the quality of the information content of the signal, and B, C, and D are measuring the amount of attention being paid. But both of them are necessary in order to get a lead lag. Like if A has no information, there's nothing to friction about.
But if A had lots of information and B, C, and D didn't, what would you expect?
B, C, and D didn't. What do you mean by didn't?
In other words, what I heard you say was there's
so let's say A has
multiplicative.
lots of information, but there is no cost associated with B, C, and D. Okay, and then you would get something that would make Gene Fama happy, that you would get strong contemporaneous correlation and no lead lag.
Okay.
But you still need A to get that correlation to start with. Okay, so complementary intensity. Okay, so here's a measure that the referee likes. So we're changing all the early tables to show this. So what we do in table 7 is we look at the returns of the focal firm, and then we just split our complementary returns into the closest, the second closest, and the third closest. They are still, so the top 2%, the next 2%, and the next 2% in terms of distance. Okay, and what you see is this monotonic decline in the correlation. So the shocks from firms closer to the complementary network are more predictive of the focal firm returns. Okay, so the referee liked this, so we're going to do this for all the fundamentals too, and it all works out. Okay, so now the fundamental correlations are stronger when the distance is closer. So contemporaneous as well as lead lag. So sorry, yeah, and the portfolio returns is also the same, where you find that the strongest in the excess returns are the strongest, and then in fact you go to medium, you lose some, it's still significant. You go to weak, it's still there, but again weaker. Other focal firm characteristics: high peer number is the degree of network centrality. The others are investor attention proxies. So this is, we did split it up in terms of explaining it. So John was right. The first one, it has to do with sort of how close they are. The second, third, and fourth have to do with how attentive people are. And the fifth is how much it costs to actually arbitrage this thing. And they all load the way you'd expect. The way you expect if this is mispricing with a slow adjustment. They're much harder to explain if you have a sort of a stochastic discount factor type risk-based explanation. Okay, now to really kind of show that this is not really risk, you can actually look at the short-term returns around future earnings announcements. And if it's really a mispricing that gets corrected as new earnings are released, then you would expect this predictive power to increase around short windows, future earnings announcements. And that's exactly what we get. You get this strategy generating more than 4 times higher returns in the short windows around future earnings dates.
Sorry, I'm going to chip in for one last time here. So this is where I'm just going to express skepticism with a capital S, if I may, which is you've got 13 million observations here. I would venture that it seems a bit aggressive with a T-set of 3.3 or 2.3 to say too much.
These are very short window returns, and we're predicting the long short, right? We're not predicting I'm just saying we're predicting the return spread. The only reason for doing this is only to show that the magnitude is 4 times, 5 times bigger. They're predicting returns across the entire month, but if it's around the earnings announcement, the effect is 5 times bigger. That's all.
Yeah,
it's just the difference in the coefficients when you have both of them in there.
Right. So if you had 1.3 million observations, right, then all else held equal, I'm going to guess that your T-stats will be insignificant. So my only point is, I think the strength of the inference one can draw here is potentially risking overstatement versus it's just a big N phenomenon to sort of use one of Jim Olson's elephants in the room sort of aspects here. Again, and not criticizing you per se or the paper per se. I'm just concerned about huge N potentially leading to stretched inferences.
Okay.
And in that regard, I think
remember, think of the role this piece of evidence plays in the context of the paper, right? It's I should probably just demote it to the internet appendix, right?
Yeah.
So I just want to point out that it is consistent with papers such as yours, which talk about basically how are you going to separate mispricing from risk, and this is just one way, because most factor-based models don't anticipate a 5 times jump in expected returns in a one-day window. That's all.
Okay. Thank you for hearing my critique.
Sure. Okay, so here's the last table, and it's good. We have about 10 minutes left. So we do a new test, right? So every Tuesday, the U.S. Patent Office publishes newly granted patents, and Kogan et al. Show that these events actually trigger substantial trading, and so they construct a measure of the market value of the patent based on the cumulative abnormal return on those dates. They acknowledge that it's a noisy measure, but it gives you a sense of what the economic value might be of the patent to the firm itself. Okay? And so we use this focal firm patent CAR, the cumulative abnormal return of the focal firm on its patent release date or approval date, to examine the way information shock transmits from the focal firm to its competitors, not to its complementors. So now we're looking at an event that's really, I think, we would say it is kind of a confirmation of innovation. Okay, it's not goods and services transferred. So we're not looking at an event where focal firm has an economic breakthrough or an affirmation of a patent, and we look at the correlation between the focal firm patent short window return and the average return of its economically linked peers. So we're asking if we can identify a shock of this nature, and we can measure its magnitude using this Kogan et al. Sort of patent CAR measure. When does this return show up in the returns of its peers? And that would be its industry peers, its technology peers, and its complementar peers. Okay, so now we're going the other way. We're just looking at it, and we are using this particular signal because it is kind of a very identifiable, specific information event. Okay, so what we're asking is, can an information shock to the low focal firm propagate to its complementors? And this is, to our knowledge, a novel test. Most of the time, people are looking at momentum spillover. The focal firm is sort of the recipient of the spillover. Here we see that. So if we take we're looking at industry peers and technological peers. And so when the focal firm returns measured between days 0 and 1 of the patent release, patent approval, we see that this magnitude of returns is correlated with the contemporaneous monthly returns of the industry peers and the tech peers that are not necessarily in the same industry but have overlapping technologies. So this is not surprising. It's sort of just confirming the idea that these patents have spillovers, or innovations have spillovers that are being realized in returns of known peers. But what is interesting is that we see it has ability to explain contemporaneous returns for also these complementors who are not in the same industry. And in fact, the magnitude of the correlation is monotonic in the distance measure. So strikingly, if you control for firm fixed effects, month fixed effects, the focal firm's patent CAR is positively correlated with the returns of its complementors. And this complementor is a function of the intensity or distance between them. And then what we find is that what happens, is there a lead lag? So now we're looking at month T+1 returns of the focal firms. And again, we see that there is a monotonic relationship where only the strongest, well, not only, but the strongest, the ones with the closest distance predict more the next month's returns. And as you go to the week, it gets weaker. And when you go to the next tier of 2%, it's gone. And also, we find that actually the industry and tech returns of it doesn't predict industry peer or tech peer returns next month. I think that's because all the correlation is being absorbed in the same month. There is no lead lag when the relationship is very transparent. So the relationship the lead lag, the predictive power only exists in medium and strong distance measures of the complementors, which is where the more subtle linkage holds. Does that make sense? Okay, so well, we kind of like that result. But so let me summarize the main findings. I have about 5 minutes. So we find a strong co-movement in fundamentals among complementors. We find a strong return predictability, lead lag relationship in returns. We see that the evidence seems to point towards a slow adjustment to price, to new information and not sort of risk. We show some evidence that shock transmission goes the other way as well. So we would say the inter-industry information transmission occurs along productive complementary networks. And these effects are quite relevant to asset prices. In fact, if I were to summarize, I like to sort of step back and ask, what did I learn after I've done a paper? What are the things that I would say main takeaways that I explain to, people like my MBAs? So number one, we have a new way to measure economic distance. Okay, I think this is important because what we are doing is identifying a group of companies with very close economic affinities, even when they have no direct vertical or horizontal relationship. I think this is of broad interest, not only to hedge funds, but basically just for our understanding of what we call peers, and I think that this might be of interest to you, but it's something I learned, that there are other ways to measure distance that are potentially less obvious, but really important. The second thing I learned is that economic shocks propagate along complementarity networks. This is exactly what the macroeconomists have predicted for a long time, but now we have stock level evidence. And I think that's why they were interested in this paper, that you can actually see it at the monthly, the quarterly, the annual level in accounting fundamentals, as well as earnings and returns, okay? So, and then the third thing is that informational frictions affect the speed of transmission. And here, things like how close they are, that is how relevant is the signal of one firm for the other, how economically close they are, how much media covers them, how much media coverage they get, how many analysts follow them, or especially common analysts, and how costly it is to arbitrage it. They all seem to affect the speed of transmission. So those are the things that I think I learned. And I would conclude by saying that shocks propagate across industries and in capital markets along complementarity networks. All right. Professor Hand, yes, sir.
Number one, on your key takeaways, do we still have the new way? I'm going back to what you said about is it the BEA getting rid of the data that they used to provide?
Oh, yeah. Okay, so good question. So yeah, this is still quite doable. So what we show is that, the BEA structure changes very little from year to year. And so what we do is we do the results using the most recent BEA, and then we use the result from the previous BEA, which is 5 years old. And we do it for the previous, which is 10 years old. These are all the internet appendices. We show even 10-year-old stuff largely retains its characteristics.
But so will the BEA be going back to the old system going forward to
yeah, we don't know. Actually, honestly, we don't know. But if you ask me how I would implement this right now, I would use the last one, and I would rely on the fact that that structure ages pretty well. Now, it's not quite as well as California Cabernets, but it actually, 10-year-old is still quite good.
Oh, I would just send them the paper and say, hey guys, if you want to do something to help
I think that would be even better.
Right?
I would think that would be even better. In fact, if you go even more granular, we would be grateful. I think that would be, okay, let me write that down. Right. Okay, yeah, I think,
and I had one other question. So have you heard of visible alpha?
If you have a what?
Have you heard of visible alpha?
Visible alpha.
Visible alpha. It's an organ. They suck in all the analyst models, et cetera, et cetera. It's set up by 5 of the big sort of investment banks, I think back in 2015 or 2016. I only raise that because I'm wondering about the aspect today of what you found with regard to analyst aspects of your findings. So in other words, it might be that today there's a lot more availability to sophisticated investors of what exactly all analysts are doing versus, quote, the old days, so to speak, 20, 30 years ago when, analysts would send out their stuff on paper. So I'm just, that may be something to look at down the road. Visiblealpha.com. It's well worth going to have a look because I think it's a pretty significant innovation.
So you think that the consumer's usage of analyst data is more sophisticated now, right? Because of visible alpha.
Yeah, particularly for sophisticated investors, that data is more available in a great form than it ever used to be. I think that might be worth something just looking at.
Yeah. I think that may be quite true. But we do show that the result is pretty strong, even though they have no common analysts.
Yeah, I'm just thinking about going forward. So, yeah.
Okay. Yeah, I think this is like any other alpha signal. It's like it starts eroding as soon as people start making it transparent. So here I am trying to work myself out of a job again. So any questions?
And David?
I just have one last question. It's regarding the economic theory. In Jones, 2011, intermediate
Yes.
goods and weak links in the theory of economic development.
Yes.
So this complementarity measure that you have here, it looks at everything in aggregate, but then have you also looked into like the weakest link within the complementarity?
So how would you define a weakest link?
So within that aggregate, if there was just one firm that was doing very badly, then that would probably be the weakest link.
Oh, I see. So it's not really a firm, you know. In Chad Jones's paper also, he's a macroeconomist. He's looking at an entire sector. You know, he's basically looking at large aggregations of firms, and he doesn't really mess around with firm level stuff. He's looking at industries and geographic regions, and he would argue that any one of them could be a link, but I don't think he would think in terms of firms. You know, and here too, it would be difficult for us because the IO table is really at the industry level. Yeah. So it would be hard to know how a single firm's performance will. It really, you know, the firm level stuff shows up in terms of each firm's exposure to the industries, the focal firm stuff. And it also shows up in that we're looking at the returns of the portfolio of peers, okay, at the firm level, so return. But other than that, it's really all much more sort of, it's not that granular.
Yeah, thank you for clarifying my understanding.
Yeah.
Really, my last question. So we don't often have a chance to hear from some of your incredible experience, Charles, but the big picture question would be, for me, do you believe that US capital markets, stock markets, are getting more or less efficient over time? And what sort of forces, pro and con, might be embedded in your answer?
Okay, great question. So I'll tell you, the big picture is, there's a really good book. The title is called Efficiently Inefficient. Efficiently Inefficient, Lasse Peterson, right? So when you ask me whether markets become more or less efficient, the basic idea is that one way to think about how much in aggregate market is inefficient, so how much mispricing is present, let's say over a year, you can look at how big the industry for active investing is. Okay, so because at least in the Grossman-Stiglitz type world, the cost of information in aggregate should be roughly equal to the rent extracted by the people who have to make a living off of the information they invested resources to find, right? So in that measure, the active management industry, in terms of even a rough approximation of the revenue that's coming in, is still very large. Okay, so now it would not be sustainable unless they are at least covering their fees with the alpha they generate pre-fee. Okay, so in other words, even if they get 100% of the alpha they generate, the sharing rule is they get 100 and you as a capital provider get nothing, which still doesn't make any sense for equilibrium. Even then, it's a very large amount of inefficiency. Now, then comes back to the question, should I become an active manager? That's a different question because the market is efficiently inefficient. So in aggregate, it is inefficient, but the business itself is a competitive business where unless you have an economic rent and have ways of protecting that sort of barriers to entry or ways of protecting your advantage as the world changes, then you will not generate abnormal returns. And not only that, you have to realize that the good and service you're in is a limited shelf life good, which is information, which like fresh flowers only lasts a little while. Therefore, you have to keep generating. So, but that does not make you any different from almost any tech firm, right? Because everything you show the world is going to emulate. So that works, you know, like TikTok now has lots of knockoffs, but TikTok had a big first mover advantage. So that's true also in active space. So I don't think that the market for certain types of information has become much more efficient, but other types of information, it actually has become potentially less efficient because new things are happening all the time that is not fully incorporated yet in price. And you can roughly guess in aggregate how much it costs to make it really efficient by looking at all the fees that are being charged by active managers in sum, which is, asset under management is over 90 trillion active. So even at 1%, that's $900 billion we spend as a society to make markets roughly efficient every year. That's the total. And that number fluctuates, but it has not, even though a lot of movement has been shifting towards passive investing, the total hedge fund plus active space is still very large. All right.
Are there another question? If anyone have any questions, you can open your mic and ask your question. Thank you very much, dear Professor Charles Lee, for your contribution and excellent presentation. Thank you very much for contribution and your effort. It's been really appreciated. Thank you very much. Thank you everyone to join us today, and thank you very much, dear Professor Charles, for taking the time out to present to us. It's been really appreciated. Thank you very much.
Thanks for dropping by. I appreciate sharing your day.
Yeah, and I hope to see you soon in Egypt. You are very, very welcome, dear Professor Charles.
Oh, I'm grateful for the invitation. You're welcome to come to Seattle.
Yeah.
We get less traffic probably.
Yeah. You are very, very welcome.
All right, take care. Bye-bye.
Thank you. Good
You're
to
so
see
welcome,
you.
Bright. Okay, take care.
Thank you, Mohammed.
Thank you. Goodbye.
Bye-bye.